Hey guys, how's it going? Tomas Patterson here. Welcome back to another video from Boss Financial. Today's going to be a little shorter video for those who don't have too much time, but there are definitely some gems in here that you can take away with you so you can get the best of both worlds. If you're someone who's starting to think about investing, deploying your capital in the stock market, or maybe you've already opened a trading account and you've already started making some purchases, today I'm going to cover 10 of the worst investing mistakes that beginners tend to make. If you're just starting out investing, that is, you have fresh legs on your financial journey, then I guarantee you're going to make at least a couple of these mistakes, maybe even half or more, because even the experienced investors, they tend to make some of these mistakes as well. Becoming aware of some of these common mistakes and taking the steps to help prevent them before they happen can have one of the most important impacts on your path to wealth, because if you make these mistakes firsthand, chances are you're going to lose money, And even as Warren Buffett has said, rule number 1, never lose money, guys? And rule number 2, never forget rule number 1. So we're about to get right into it here, but please don't continue watching without doing me a favor and smashing that like button for me. Hit the subscribe button to stay in the loop, become part of the financial community. It really helps me grow my channel, especially with the YouTube algorithm and all the positive feedback, so I really do appreciate it. I post videos like this on a regular basis, so if this is the content that interests you, then just make sure to like and subscribe. So item number 1 on the list of things not to do is to try and time the market. As I've mentioned in previous videos, active management of your portfolio is almost a sure way to lose money. You want to take a more passive approach to investing, by doing 2 things. Number 1, always be buying, and do not be selling. And number 2, be patient, and let time do the work for you. It's been proven that it's virtually impossible to time the market compared to being fully invested for the same time period. We talked about how financial institutions, experienced fund managers, even Warren Buffett himself stated that he cannot time the market and it's pretty much useless to try. In reality, the stock market doesn't price things fairly or correctly all the time, And no given person knows what the market's going to do on any given day. For this reason, it could be a good idea to invest in an index that tracks a market over a period of time instead of trying to get in and get out. You don't want to make the mistake of watching the markets every single day, because all this is going to do is stress you out and you might be tempted to sell at a loss if you're in the red. It's actually best to think long term, buy and hold, as well as average down to get the best returns possible over time. Everyone always wants to get in low, get out high, and just repeat this over and over again to get the maximum returns. But guys, trust me, it doesn't work out like this. You might get lucky for a little bit, even a long bit, but you're just guaranteed to lose money this way. Now, mind you should still be using an active investment process, You shouldn't be disregarding valid opinions and research. It's just typically market timing does not beat a buy and hold strategy long term. Next up, number 2 mistake, guys, is investing too little. Now, don't take this the wrong way, I've said it before and I've said it again. As long as you're investing, that's what's important. The best time to start was yesterday, So just focus on getting whatever amount of money you can afford into your account regularly. But in contrast to this, when it comes to investing, I'm talking about when you're actually making purchases. You want to build up enough money in your trading account first. That way you can buy a lot more shares of a company, which is going to give you better returns. There are trading fees, that eat into your returns. So even if it's $5 or $10 per trade, this adds up over time. So even if you had, let's say, a $10 trading fee, then you're going to pay that when you buy and you sell, So that means that you need to make an extra $20 on your investment just to break even. So for example, buying 2 shares of a $30 stock, that doesn't really make sense, once you factor in trading fees. So it's better to build up money and make fewer larger purchases as opposed to a lot more lesser purchases. Now, me myself, I don't always have the most money to invest, but I generally don't make purchases less than about $400 to $500, where my trading fee is less than 2% of my purchase, So just keep that in mind going forward. Item number 3, guys and girls, do not chase yields. What I mean by this is the fact that newer investors commonly look to dividend-paying stocks to invest in, and they immediately start looking for companies with the highest paying dividend yields. This can actually be a really easy way to get burned, because often these high yields, they can be alluring, but it can really mean bad news for the company. A company could be taking on a lot of debt just to pay these dividends, and this could be a bad indicator, So this could be a signal even that dividends could be cut in the future. It's easy to see a yield of 14% compared to the standard yield of maybe 3 to 7% and think that this is a no-brainer, But trust me, the day's going to come eventually and you're going to end up paying for this. It's important to focus on good companies first and not even pay attention to dividend yield, Because dividend yield has nothing to do with the financial health of the company. You want to look at companies with good financial statements, good revenue and growth, as well as good indicators like payout ratio, which tells you how much of a company's income they're paying out in dividends. If this is too high, then it leaves little room for growth in the future, as well as they might be able to not even pay the dividend in the future. Remember, yield is a percentage of the stock price. So if a stock price were to fall, then this would reflect a higher yield. So one person might think that this is a good thing, but this could also mean trouble, okay, because the stock price drops. So there could be something going on there. If you're investing in good companies with a solid track record, then you don't have to worry about dividend yield, okay? It's just generally the higher the yield, the higher the risk you're taking on, and you need to understand that. Number 4, the worst investing mistakes that beginners make, guys, is buying stocks based off of chatter from the TV and internet. No matter where you look these days, there are always buying opportunities, okay? Some are good and some are not. You just have to remember that the stock market as a whole, it's a zero-sum game, okay? So there's always going to be some winners, and then the other half are losers. It doesn't matter what show you're watching, what news station you're watching, what article you're reading. There's always going to be opinions out there, and there's always going to be people trying to tell you what to invest in. But the key is to do your own research to back up any of these claims. People tend to push the news that's in their own personal best interest, hoping that people, or sheeple in this case, are going to follow their choices, which in turn is just going to benefit them. You just have to realize that there's no secret formula, okay? Do you really think that if someone knew which way the market was going to go, or if they found an undervalued company or the next big thing, that they're just going to be out here sharing it with the rest of the world? No, they would want to keep the secret to themselves and make all the money themselves, okay? So just be very careful what you're investing in, be wary when you're listening to others, and do your own research and analysis. Remember, only you are responsible for your own money, so make sure you're investing it well and don't ride bandwagons. Next up, guys, number 5, something you do not want to make the mistake of forgetting is taxes and fees. So many people just jump right into investing, they're buying and selling, and then next year come tax return season, they realize they have to pay the piper. Unless you're using a tax advantaged account, that's a TFSA or a Roth IRA or your RRSP, then you're going to be subject to these taxes, which could be things like capital gains, eligible dividends, and even other distributions. Remember, investing and gaining from this is an income source technically, okay? So you're not just going to get off scot-free from paying the government. You have to claim this as such. Mind you, taxes from investing are much lighter than the taxes you're going to pay from your regular job, okay? Because that's earned income. On top of this, trading fees also eat into returns like we talked about earlier, okay? So just make sure that you're aware of these things and that you plan accordingly. That way you don't get hit with a big surprise. Because your returns might not be as high as you think they are if you're not considering things like fees and taxes. Now for number 6, guys, it's very simple. A common mistake that beginning investors make is not diversifying their holdings. This all comes back to risk, okay? It's proven that diversifying your holdings reduces the risk because you're not putting all your eggs in one basket. Think about it like this. If you put all your money into one stock, what happens if that stock tanks? Whether it's because of earnings, legal issues, any other sort of fear in the market, if this stock plummets, then you have that as your only holding, then you can lose up to 100% of your money. Now say if you held 20 different equally weighted stocks, then the most you can lose now is 5% of your portfolio. And this isn't just for individual stocks, okay? You also want to diversify across multiple industries and even economies, okay? So say US stock market, the Canadian stock market, as well as overseas. You can look into things like those for maximum diversification. But also remember, you don't want to over diversify, okay? Because your losers are going to end up eating the returns from your winners, okay? So you want to have a good balance. Next, guys, a simple concept to utilize and understand is reinvesting. When you receive dividends or capital gains from selling, then you should always be reinvesting these back into the company or at least another company that has a fair valuation and it presents a good buying opportunity. This allows you to obtain the best returns possible as well as take advantage of compound interest, which is going to increase your wealth dramatically over time as your money works for you. And I'll repeat this fact about Einstein forever, okay? Einstein himself deemed compound interest the 8th wonder of the world. So say you've already gone and you've experienced the other 7. Well, this is your opportunity to now experience number 8. Item number 8 on the list of mistakes is not following a strategy. If you're just starting out, chances are you don't have the most experience and you might not even have a strategy because you're just that excited to start investing. Well, this is a good thing, but you need to stick to a strategy, okay? So I'm not going to tell you what strategy to do. There are lots of them, okay? You could be a long-term investor. You could be a short-term investor focusing on day trades, swing trades, stuff like that. You could do futures and options. You can focus just on dividend-paying stocks, or maybe you want to focus on margin trading, okay? Shorting stocks. Everyone's different with their own expertise, with their own goals, and with their own risk tolerance, but the main thing that's important is that you just find a strategy and you stick to it. You want to leave emotions out of it, okay? And just work on being consistent and following your own rules. You don't want to enter being a long-term value investor, but then next thing you know, you're caught up in some hype and you're shorting penny stocks with leverage money, okay? It's the easiest way to lose a lot, if not all of your money, if you're not picking and sticking to a strategy. Getting close to the end here, guys. We're on mistake number 9 here that beginners make while investing, and that is not accepting losses. I'm going to be real blunt about this one, guys, okay? Unless you're some sort of superhuman investor, I wouldn't even classify Warren Buffett as someone like this. It doesn't have to be tomorrow. It doesn't have to be 10 years from now. But at one point in your financial journey, you are guaranteed 100% to lose money. Now, as much as we'd like to prevent this, sometimes you just can't, okay? So it's important to recognize this and cut your losses when it's the smart choice to do so. If you're a long-term investor and one of your positions is in the red currently, then you might choose to continue holding it because you're a long-term investor, but sometimes this isn't a smart idea, so hopefully you're able to recognize this. I wouldn't hold a company at a loss for more than 2 to 3 years max because think about it, all this time's going by and your money isn't working for you like it should be. You're missing out on the opportunity to sell and then invest in something else because even though you lost money, you'd still be making more money than if you were to just keep holding this losing stock. You can still regain some losses as long as you choose to act before you lose all your money. And on top of this, you do not want to do the unthinkable and let emotions take over. Don't buy into a losing position when the price drops just to try and average down, okay? If this is a good company, then take your calculated chances. But this is what we call buying into a falling knife, and it's a really easy way to lose money. So this happens when someone buys a stock, the price drops, and then they continue to buy more, and the price just keeps dropping, okay? It's like lighting your money on fire, so just do not do this. You're gonna lose money. Do your own research, do your own analysis, and then determine whether or not it's a smart move to keep holding a stock, or if your capital would just be better off somewhere else. Lastly, guys, I'll leave you with this. Number 10 of mistakes not to make is withdrawing early. It can be tempting to sell assets when you've achieved a good return. And this isn't a bad idea, okay? According to your strategy, you should be choosing the right time to take profits to secure some gains if you want. But this is different than withdrawing, okay? If you're a long-term investor, then this is just defeating the purpose of investing. You want to grow your portfolio, but this is never going to happen if you keep emptying your trading account, okay? So you want to consider this money as locked away. Don't touch it. You can reallocate assets, you can move funds around, but when you're taking this money out, you're withdrawing it, then chances are you're going to spend it, okay? That money's gone forever, and then you're missing out on the opportunity to then invest and have this money work for you for the rest of your life or up until retirement. If you need money that badly, then you really shouldn't be investing it in the first place. So me, myself, I have the long-term perspective, right, when it comes to investing. So I don't do any withdrawals. I want my money to work for me and compound. And once you start viewing this money as locked away, then it's going to get easier and easier. With that, guys, we're at the end of today's video. Thank you so much for watching. If you got some useful tips out of this video today, make sure to hit that like button for me. Just give me a thumbs up, as well as don't forget to smash that subscribe button, okay? Stay in the loop for all my future uploads and become part of the financial community here. You can also click that bell icon there to stay updated with my future videos. You'll get a notification every time I drop a new one. And go ahead and share this video with someone who you think needs to watch. Keep these mistakes in mind as you continue down your path to financial freedom, and feel free to revisit this video and refresh your memory anytime you need it, okay? Because professionals, they're even bound to make some of these mistakes, so don't feel bad. Questions, comments, leave those in the section down below. I'll be sure to get to those, as well as don't forget to follow me on Instagram at Boss Financial Channel. Regular content posted there. With that, ladies and gentlemen, as always, thank you for watching, stay positive, and see you next time.